Okay, in this video we are going to look at counterparty risk, and this is the topic: pricing and hedging counterparty risk. So most of the counterparty risk is about measuring pricing and other risk management, that is uh, the risk involved in over-the-counter derivative trades. So the calculations of counterparty credit risk is referred as credit valuation adjustment, and although it's a complex risk, but banks are required to hedge CVA risk. Market factors that drive change in exposure, including foreign exchange rate, interest rate, credit spread, commodity pricing, and equity price. So these all things actually drive the exposure that the bank has. These factors can be used to hedge changes in the exposure. Some banks use a single CVA desk to manage risk, while others use decentralized approach, establishing CVA desk in each major trading unit. There are frictional cost, wrong way risk, out of the money risk, which increases the complexity of modeling and managing CVA risk. Netting agreement and financial collateral are risk mitigation, but neither of them perfectly eliminate the CVA risk. That was in very short what we have here in this counterparty risk chapter. So let's understand what's counterparty risk from ground zero. So counterparty credit risk stemming from over-the-counter derivative transaction have been a source of systematic risk and a persistent feature of recent financial crisis. OTC derivative transactions have grown steadily since 1980s, and much of the growth has been concentrated in interest rate and cross-currency swap agreements. Large internationally active commercial banks are the dealers in OTC derivative trades and thus face a significant amount of credit risk. In an OTC derivative contract, two counterparties will likely have to make a payment to one another on the terms of the agreement. For example, in a plain vanilla swap agreement, the parties do not exchange payments at the inception of the agreement but make payment in subsequent time period based on the notional principle of the swap agreement. So when we look at the interest rate, the payments in the subsequent time period are based on the notional principle of the swap, and the difference between the floating and the fixed rate. So as a result of these kind of financial obligation, there is a credit risk involved in the entire system. And counterparty credit risk is the financial risk of loss arising from one or more of these parties failing to fulfill its obligations under the OTC derivative contract. Counterparty credit risk was the key element in the financial crisis that began in 2007. Losses resulting from this specific type of risk amounted to hundreds of billions of dollars. One bank alone nearly lost 10 billion. Banks and banking regulators have increased focus on the area of risk management over the past several years, improving the process needing to measure and price counterparty credit risk. So we now got something about what we mean by counterparty risk. Now let's move to credit valuation adjustment. So what do we mean by credit valuation adjustment? Now credit valuation adjustment, also referred as CVA, the short form, refers to the calculation of counterparty risk. So we'll calculate the counterparty risk that bank faces. A simple unilateral calculation of counterparty credit risk, that is the risk faced by banks, used to apply when evaluating counterparty risk. However, current convention suggests calculating the risk faced by both the bank and the counterparties. This bilateral approach to risk measurement is supported by accounting conventions and practice. The mid-market value of an OTC derivative contract refers to a credit risk-free valuation. In order to reflect the market value of the credit risk, CVA is applied to adjust the credit risk-free valuation of the portfolio of the OTC derivative. So for example, if there are two banks and both of them have many contracts with each other, not just one. So the CVA will be negative if bank A faces more credit risk than its counterparty B, and this means that the value of derivative products is lower than the mid-market value from the perspective of bank A, because bank faces more risk, credit risk, than its counterpart. Likewise, CVA will be positive if counterparty B faces more credit risk. So if you were to just look at the convention, negative means that you are at a loss, positive means you are at a profit. So when we talk about bank A and the counterparty B, then we are referring from bank A. So a negative sign at bank A means that A faces more risk. A positive sign means A faces less risk and B faces more risk. So it could be like B has got a bad history of doing default. So when you sit from the table of A, your CVA would seem to be negative. So that's what we mean by credit valuation adjustment. Now we have a formula which is expected exposure into loss rate minus expected exposure of B into loss rate. So this is the formula that we use. We are going to look at the numericals at some point later in time. We now move to the CVA calculation, unwinding with monoline insurers. So monoline insurers sell financial guarantees to issue that ensure credit of an issue. The insurance often involves an agreement to reimburse for loss occurred up to certain amount. One of the effects of the insurance is to boost credit rating of a bond issue. In recent financial crisis, monoline insurers sold credit protection on senior tranches of ABS, of CMBS, of CDOs. So those were really hit if the CDOs or the ABS fall down. So bank had large credit position with monoliners. As a result, the credit quality of monoliners deteriorated rapidly when the implied loss of the underlying pool of ABS and CMBS increased dramatically. Credit risk widens to thousands of basis points on an annualized basis. Many banks unwound position with monoliners but were forced to do at a deep discount from mid-market. So this is what happened in the crisis period. Now CVA calculation is used to be done by Monte Carlo simulation. Now I have several classes and this what's Monte Carlo simulation explained at different locations, but I'll go through some of the things that's relevant here. So in a Monte Carlo simulation, the evolution of all prices and potential default events are simulated thousands of times over the life of the derivative trade. This fully fledged Monte Carlo simulation can help us to calculate the CVA. So the various things that are used to calculate the Monte Carlo simulation CVA is recovery rate, hazard rate, correlation, volatile drifts and other phases which forms the input of the model. Then given a simulated default, a gain or loss to the non-defaulting party is calculated and discounted at time 0 using appropriate stochastic discount factor simulated along the market path. Will don't worry if you don't understand this term stochastic. It means that it's not dependent on the previous value and it could go in any direction, something like the Brownian motion. So relative to the mid-market value, bank A's default causes a loss or a gain to counterparty B when trades are closed out. Likewise, counterparty B defaults causes a loss to bank A when trades are closed out. All losses and gains are averaged over the simulated market path. Thus, the average is the CVA. So we will draw all those paths. We'll keep the probabilities of A and B defaulting, and we'll calculate all those paths. Find out the average of those paths for both of them. So the important elements of CVA calculation are that are included in Monte Carlo simulation are like risk neutral, market dynamics, recovery rates, correlation between default event, volatilities and other factors. Also comprehensive loss calculation including transaction cost is made. It is assumed that in the event of default the OTC derivative trades are closed out. Parties may have the option not to close position, but it is but closeout is likely in the event of default, especially from the derivative deals. So banks are more likely to use a simplified model other than a full Monte Carlo simulation. In simplified model, the expected exposure EA and EB are profiles, that is curves or vectors of condition on default expected exposure over the life of the portfolio trades in present value terms. The exposure profile factors in credit risk mitigants such as early termination provision and netting allocation agreement. So these are calculated by either Monte Carlo or we can do that analytically as well. Now we saw the loss rate which was multiplied in an equation that I just took you through. So loss rates are profiles of forward loss rate implied by the price of the credit default swap on counterparties A and B. If the credits do not trade in the marketplace, the losses are derived from generic credit spread. The spread should be based on traded credit spreads such as credit indices, so that the trade prices can be used as hedge, and if not, the bank cannot hedge the CVA. One interesting thing here is that if you want to use any probability of default, then the input that should be formed should be based on the market prices, and we should calculate the probability from there and use that as an input in our model. Then we have the zero case CVA, the last point here. So if the fair value of the product of the OTC derivative that trades between bank A and its counterparty B is its mid value, then the CVA is 0. The 0 CVA is ideal and may be used as reference against which other cases may be compared to determine the value of actual CVA. 0 CVA exists in a perfect market environment with continuous prices, frictionless market, perfect margin agreements, and with continuous marking to market, perfect and certain closeout procedure, collateral rights, and legally enforced netting. So in the 0 CVA case, bank A and B faces 0 credit risk with respect to each other.